Well, good morning. Welcome back to the broadcast, Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, October 16th, 2021. And here's our top story today. The SEC signals new rules for online brokers and a lot more. Joining me now to discuss this and a lot more, Dave Banerjee is the Chief Executive Officer of R&D Resources, Inc. Dave, great to see you again. Thanks so much for joining us on the program this morning.
Thank you. Yeah.
So I want to talk about Securities and Exchange Commission developments, but let's start off with the role of the SEC, because this is really important for people, especially investors, to understand. So what is the role of this regulatory body?
So created by Congress, and I don't know which year, but the significant role is it's a market regulator, including participants in the market, has two objectives. One is investor protection, and the second is orderly markets. So those are the two significant approaches that the SEC is charged with. And yeah.
No, go ahead, David. Finish your thought.
And so they've been doing it, they've been doing it for a long time. It's a pretty, they follow administrative law procedures. They have substantial resources, and they do a pretty good job. So
yeah. Well, no one's perfect, but they can always do better. And we got to hold them. We got to hold their feet to the fire to help them do better. But Dave, let's talk about when we last had you on. You talked about gamification. There was some scrutiny around, or is continued scrutiny around Robinhood, the GameStop, the things that were going on with GameStop and AMC. What are the latest developments with respect to the SEC? What are they looking at, and what can we expect as investors and interested parties?
Well, they're looking at tightening the rules on platform products that provide market access to individual investors. Their concern is that there's a level of individual investors that are being accessed by these platforms that may not have the wherewithal, the education to understand the risks that they're getting into. And they're being nudged on due to inherent conflicts in these platforms that are providing market access.
And so it behooves the SEC to make sure that things that if they need to be disclosed, that you as an investor, if you're using one of these platforms, that you're aware that there might be some of these conflicts before you invest.
It's actually a little bit more than that. It used to be that disclosures by themselves is sufficient. The disclosures got so pronounced that they ended up with what I call mattress disclosures. When you buy a mattress, it has a disclosure that says, under penalty of law, don't cut this tag off. And the first thing you do is you cut the tag off.
Cut the tag off, that's right.
So the mattress disclosures were not achieving the end. People were clicking in, yes, I understand, when really they didn't understand. So the SEC is moving forward and has. This is not something new. That basically says disclosure by itself is not sufficient. Disclosures is an important concept, but you need to stop what Gessler had said, nudging these inexperienced investors into a route which is beneficial to you and possibly hurts the investors. And that can go into the GameStop scenario, which has brought some of this into light, where people are trading based upon tips as opposed to really understanding what they're putting their grocery money into.
Yeah, and one area that I wanted. So when we had you on last time, you kind of gave us the breakdown of what happened with GameStop and the margin calls and all that kind of interesting stuff that people probably did not understand. A lot of people got hurt. I want to ask you about cryptocurrency, because I see where some of these platforms are now also touting cryptocurrency, and this is an area where the SEC has really started to weigh in as well, knowing the volatility with the things with cryptos like Bitcoin and Ether and Tether, and there's a gazillion of them, right? This is another area of interest for our friends at the SEC too.
So cryptocurrency originally started as a medium of exchange that has protections from government overreach, oversight, and is cross-border in effect, which means you convert a fiat currency into crypto, and then you can take it out in another fiat currency, concept-wise. So when they did that, and they based it on blockchain technology, they put limits on the amount of quote-unquote tokens that could be issued. So what SEC had earlier indicated is that there's a difference between utility tokens, which is part and parcel of the blockchain mining element, as opposed to an investment token where you are actually issuing the token in order to raise capital. That has since now become mired because the utility tokens, because the issuance of tokens are limited and has to go through an algorithmic process for miners, they have started being a unit of investment under, the old, there's a no action, there's case law called the Howey test. And in addition to the Howey test, but the Howey test has become the core standard that basically says that you're putting money in with the expectation of it appreciating in value or providing some value. And those would then be deemed to be securities. So the SEC is doing what appears to be a roundabout face, but in reality, they're coming to these cryptos and saying, look, these are investments. And if they are investments, they should follow the investment guidelines in terms of notice, approval by the SEC, audit requirements, and controls in terms of customer, all of the standard SEC rules and regulations that are there for investable securities. So that's where the SEC is.
Yeah, it seems like to me, it makes sense. And I would imagine to the layperson, it probably makes sense as well to follow the rules. If these are investable assets and you are anticipating appreciation, you probably want to make sure that you're following the rules associated with that. David, one last question I have, and sorry to jump around on you, but we like having your expertise on, and there's so many topics I want to ask you about. I want to ask you about ESG, sustainability, and this is an area of interest for the SEC as well, around what is ESG, how do you monitor it, how do you disclose it? A lot of the information around ESG, Dave, is opaque. It's not transparent.
Correct.
And it seems like our friends at the SEC have jumped in here as well to say, hey, we need to do something about this, or at least we need to provide some level of guidance to investors.
So what happens is when public companies issue their 10Ks and 10Qs that are looked at by analysts that provide recommendations, which are subsequently picked up by investors in terms of the investment decisions, there is some extenuating risk factors, which are environmental, social, government issue, which are ESGs, that will impact the markets, and in particular, the stock of the particular company. So the SEC wants that to be incorporated not only in terms of notes and disclosures and management discussions, but also as part of the financial statements in terms of accruing for certain contingencies in the relevant areas that those public companies are in. That's the good news. The bad news is when rules are applied, including ESGs, it has some collateral effect. So you may have a software company that really doesn't have ESG exposure, but they're required to assess and include in their communication to shareholders the impact of this ESG legislation. So it creates a cost. And at the end of the day, what ends up happening is it ends up, again, like a mattress disclosure, it ends up becoming a cut and paste off of somebody else's. So it's a good concept and it means well. The practical approach of it is still yet to be seen, like you said, because it will apply to certain industries and certain public companies operating gas and oil and utilities and things of that nature. It may not apply to others, but unless the actual rule comes in, I think it's out for comment period right now. The SEC might decide to carve out or might decide to provide some relief. We don't know as yet. But yes, it's a cost. Look, at the end of the day, it doesn't matter who is initially paying for this cost. It'll all end up on the investor.
Absolutely. That's what a lot of people don't recognize about regulation is ultimately just gets passed through, and us as investors or consumers, if it's a different type of regulation, wind up paying the freight.
Paying the bill,
Yeah, absolutely. Dave, it's always a pleasure talking with you. I feel like after we talk, I have a lot more clarity around regulations. And I can tell you, I am one of the people that always cuts the tag off on my mattress. It's great to see you. Thanks so much for joining us, and we look forward to having you back on the program again very soon.
Thank you very much.
Thanks, Dave. Great to see you. Thanks for sharing your perspective. And when we come back, we'll take a look at some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. On Wednesday, I sat down with Well Spouse Association's Laurel Whitman to discuss how to avoid being caught off guard when providing family caregiving. Let's take a look.
So we'll talk about some of the smaller ones first. And you're right, I have a lot of experience. I've been a caregiver for a long time. I've talked with a lot of caregivers along this journey. Small things like my husband has a lot of hospital stays, and when he's in the hospital and I need to be there, I need to buy meals. I need to pay parking expenses. You know, I went back for this segment and looked at how much I spent for a 3-week stay he had several years back, $500 on just parking so that I could be there, on site with him. Things like getting to medical appointments if you don't have your own vehicle. People don't think about it. You think you call a cab company and they'll have a wheelchair accessible cab ready for you. They may have one. It may be in, on the other side of the county from where you are. And if you need that person to be with you for your whole appointment, you may have to pay for that. It can get very expensive for families that are already facing this kind of compression from the loss of income that many of us face, as well as these higher expenses. Things that people don't think about. So medical equipment is often covered by insurance or Medicare, and the equipment is very expensive. It's designed to keep people living as independently as possible. Things like wheelchairs, lifts to get them out of bed, shower chairs. This is not glamorous stuff, but it's really, these are tools that help you get the work of caregiving done. You normally can't try this equipment in advance. It's very expensive. You buy it, you hope it works. It often doesn't meet your exact needs. It's not returnable for safety reasons. It can often be resold because an insurance company has helped you pay for it. And I joke that my garage is a graveyard of medical equipment that my husband has used over the years. It's stuff that no longer works or it doesn't fit him in the first place, and it's just sitting out there. And those are dollars literally sitting in my garage that I can't turn back into dollars when I want them to spend on something that is useful to me. Many medical expenses that you would think are covered by insurance are not. Again, not very glamorous, but catheter supplies, feeding tube supplies, wound care, these sort of things. Insurance maybe covers one item per week for you, but you need it every day. Or they cover one item per month and you need it every week. You may not get the coverage of the tools that work best. And so families have to purchase these things ourselves. So these are some of the smaller ones. A couple of sneaky ones that I like to point out: special diets. Celiac disease comes to mind. People who have to eat gluten-free food. It's getting easier to source the ingredients that are necessary for those kind of very strict medical diets, but it's still not easy for everyone. They're not available everywhere. GI patients, cardiovascular patients, same kind of thing. They can end up on these diets that are very costly. Here's another one that most people don't think about: household utilities. And you might have seen this with working from home during COVID, that when suddenly people are in the house all the time, your utility bill shoots up. There can actually be a medical reason for this. My husband has MS, and MS is notorious for being a very difficult disease to deal with in hot weather. It literally makes you physically weaker. And so our utility bills, are very expensive because I have to keep the same temperature year round, hot, cold, no matter what. If the AC goes out, I can't let it not be repaired. It has to be repaired right away so that my house is safe for him. So these are kind of a couple of funny things that people don't really think about, I think, as medical expenses, but they're very much tied to their conditions. And then you get into the bigger ones that, again, will feel familiar, but come as a surprise. So accessible vehicles, they're helpful to have because, again, that cab is on the other side of the county from you and it's not very convenient. They cost a minimum, in my experience, of $20,000 to modify. And because it's a wheelchair vehicle, it's got to be a big SUV or van. So you're starting at a base price of about $40,000, even for a used one. Just for a point of a discussion here, I found a 6-year-old accessible van last night that you could purchase. It has 172,000 miles on it. That is a really old car, $35,000. That's just your starting price for a vehicle that, really would be difficult to resell in any other circumstance. People spend a lot of money on their houses, right? It's when you have a neurodegenerative disease in particular that's progressive and impacting your ability to get around. We're familiar with grab bars in the shower, that kind of thing, but a fully roll-in wheelchair accessible bathroom, $15,000 to $20,000. Widening hallways, putting in new flooring so that you don't have trip hazards around. Things that are easier to clean, and it's an area that is tempting to spend a lot of money because it feels like an investment in where you live, but you are actually putting money into that for yourself, and you usually don't get that money out because those repairs are pretty specific to the person who's living there, and the next person to buy your house isn't necessarily going to pay for those for you. So you get hit twice. You might decide to move instead, and moving is very costly and inconvenient if you're doing it, just because of an illness or an injury, and you aren't able to optimize that timing. It's not something we have. I think it would be a great tool for families to use. I think a little bit of the challenge here is that some of these, as we talked about earlier, things like aids and facility care, very quickly outstrip most families' ability to spend and to save for those items. So it can get very overwhelming, I think, to look at it. So, that we talk a lot in our support group meetings about kind of chipping away at the edges of these things and finding ways, different tax incentives or programs that you might use to lower things kind of at the edges. But, to your point about kind of the larger environment for fixing these things. Some of these solutions do need to come from that. When you're talking about $250,000 for aid care for somebody who needs it 24 hours a day, it's, the worksheet feels insufficient.
And on Thursday, I sat down with S&P Dow Jones Indices Maggie Dorn to discuss ESG index investing. Let's take a look.
Well, let's first start with kind of your original statement here, because I think it's really key to this conversation, and then we can definitely move into the index methodology itself. But we launched the S&P, or the ESG version, of the S&P 500 in January 2019. So coming on several years of performance on the index itself at this point. But what I always like to point out, especially with audiences that are interested in ESG investing in particular, is what a watershed moment that was for not only the ESG indexing space, but for ESG investing in particular, because as you just mentioned, close to 11 trillion in assets either are directly tracking or are benchmarked to the S&P 500. So when you think about the breadth and the reach of the S&P 500 in particular, applying sustainability criteria to that was a very, very significant move, not only for us here at S&P, but for the industry in general. And I also think that the launch of the index has also helped, and we can get into this a little bit more, really dispel the myth of an ESG versus performance trade-off. And that really is what plagued, to much degree, the widespread adoption of sustainable investing. And that is really based off of the fact, and that this is getting into the conversation around the construction of the index, but the S&P 500 ESG construction, our approach is designed to really closely replicate the risk return profile of that behemoth of the parent index, the S&P 500. And we're doing that by also providing for both meaningful as well as measurable sustainability and misnomers around the ESG versus performance trade-off came from the fact that historically these indices, or the kind of socially responsible investments or indices, were very much based off of exclusionary frameworks, right? So you had to exclude a bunch of stocks to ultimately, attain your sustainability driven goals. And oftentimes that led to excluding entire sectors or industry groups from the index, which led to, oftentimes increased volatility, increased diversion away from the actual benchmark itself, which led to underperformance. Now, with the S&P 500 ESG index, while the index is by no means designed to be exclusionary, but we do first and foremost exclude a few what I would consider controversial business activities that are generally accepted as kind of the starting point for any ESG index. So we exclude things like thermal coal, companies involved in thermal coal, controversial weapons, as well as tobacco. We also exclude companies that have a low UNGC score, which stands for the United Nations Global Compact. So for those unfamiliar with that, the United Nations Global Compact is really a catch-all for any violators of what I can call kind of these social norms, which is human rights, labor rights, environmental issues, as well as corruption. So companies that are found to be offenders and have a low score in those areas are excluded. Then we also exclude the bottom 25% of companies based on their ESG score within their global GICS industry group. So with those exclusions, what we're really trying to do is exclude the worst offenders from inclusion in the index. So we first make those exclusions, but then what we do is we divide up and we look at the companies on an industry group by industry group basis. And we go down the line per each industry group, selecting those top performing ESG companies until we accomplish 75% of the market capitalization within each of those industry groups. And that's a really important point, Jeff, because when you think about it, it provides a sector neutral approach to ESG investing, right? So we're taking a sector neutral approach. And one of the biggest criticisms around ESG indices right now is the fact that, you're just overweighting technology and underweighting energy. And that just isn't the case, specifically when you're looking at the S&P 500 ESG index. So we're taking this sector neutral approach. We're also market cap weighting the companies in the index as well, which keeps that tracking error really close, providing that similar risk return profile to the parent index itself, which is the 500. So we now have several ETFs tracking the S&P 500 ESG index, both in the US, but as well as Europe now. And I think we're approaching close to 5 billion in assets under management, reflective of that S&P 500 ESG index. I also think what's kind of an important conversation to whether you're an asset owner or a individual is the growing ecosystem around the index as well. So not only ETFs and mutual funds, but futures and options. And I think that's really going to be an interesting area of growth moving forward, is kind of accessible entry points to these more sustainably minded indices or benchmarks like the S&P 500 ESG index. And again, it was a watershed moment when we launched these, or this index in particular. We have several other kind of what you would consider benchmark type ESG indices that track globally recognized, widely known indices as well. And we only, look forward to the future in terms of launching more of those types of indices moving forward.
Well, that wraps up another episode of BRN Weekly. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. I want to say happy birthday to my younger brother. Andy, happy birthday to you. Love you so much. And don't forget, we're backing in tomorrow for BRN Sunday. I'll be joined by members of the media, academia, and financial services. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited? And do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.